6 o'clock in London, it's 1 p.m. in New York, it's 1 a.m. in Hong Kong, it's 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Anyway, greetings, good morning, good afternoon, or good evening, depending on where you are in the world today, ladies and gentlemen. My name is Patrick L. Young. The IPO-VID Livestream Series 6, Episode 3 starts here. We're into Episode 33, and welcome back to an edition for the first time in ages. We can safely presume that in our standard two-way price of 0 to infinity, for once it looks a lot closer to the zero end of the infinity scale for Bitcoin, as Bitcoin is actually somewhat subject to gravity. After all, it was, good grief, just before I entered the studio, an almost manageable something like $37,000. Good grief. Meanwhile, apparently, US Treasury bonds are squeaking up again after yields of 2.4%. Good grief. On the 30-year Treasury, we're closer to 2.3 as I speak. At the nexus of exchanges and cryptocurrency, BRICS subjected to gravity are one of the few things which fall faster than Coinbase stock. Even the London Stock Exchange Group managed to bounce this week, while Coinbase didn't get much past, well, a pure play dead catter. Not too much of a bounce there. True, it isn't below 200 yet, although it has got mightily close, but the stock is still down around 30% from an issue price, which amounts to nearly halving from its highs. And it hasn't even managed 50 days of trading yet. Last week wasn't helped by a tech outage, albeit when volume ticked up as various regulatory travails weighed on the crypto price. At least there were several exchanges that also swooned in sympathy amongst the crypto kiddies as they had to switch off and reboot to cope with the volume uptick as sellers raced for the exit. Gosh. All this and more has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse Business. Send us an email or hit me up on whatever social media stream you're looking at this particular edition of the IPO-VID Livestream. Patrick L. Young is the name, and we'll be happy to get you signed up for a 30-day free trial so you can better understand the exchange business. Our guest today is discussing life at the sharp end of prediction markets. Flip Pidot is the founder and the managing director of Sharp Square Capital LLC, an alternative investment management firm specializing in that wondrously exciting micro niche, event futures. For over a decade, Flip has been involved in the development, operation, and evangelism of political event markets as head of the American Civics Exchange, producer of the excellent prediction market content network Old Bull TV, and also market curator at PredictIt. Previously, Flip worked as an investment analyst for Boyer Asset Management, and he's a certified fraud examiner who worked for Arthur Andersen. Graduate of Notre Dame with a BA in economics and UVA's Darden School's MBA. Flip also holds a Series 3 license and is a CFA charter holder. Flip, good evening. Welcome to the show. Where in the world are you today?
Well, hello, Patrick. Good evening. I'm in New York, so it's good afternoon for me, but good morning, evening, middle of the night, midday to viewers around the world. And Patrick, thanks so much for having me on. It's lovely to be with you, if only virtually.
It's great to see you all together. It's a delight to actually find somebody who's in New York, because we've had a series of supposedly New York residents, and they've all been in Florida for the course of the last 10, 12 months while we've been doing this live stream. So interesting to see somebody actually in New York. And you're one of several who've been on the show. Most recently, I think Lynn Martin from the Intercontinental Exchange. So Flip, tell us a bit about yourself. I mean, you've had an interesting career in financial markets, doing various tasks. How did you come to be in finance in the first place?
My career, and as you mentioned, really started out first job right out of college was in forensic accounting for Arthur Andersen. But since that stint, it's been sort of a combination of financial markets and politics, and in particular, increasingly at the intersection of the two. So this project that you mentioned in the leader there, American Civics Exchange, is a firm that I founded a number of years ago with the ultimate goal of bringing this fledgling, maybe is even too aggrandized a word, but this theoretical asset class that we envision, namely a regulated on exchange environment, trading environment for event futures tied to political outcomes. So in other words, having an exchange traded mechanism by which investors and companies in highly regulated industries can offset, manage their policy risk, their political risk, the same way that they would offset or manage any other exogenous financial risk, whether it's the price of soybeans or interest rates or Forex. Companies don't want to be, and we don't want companies to be in the business of speculating on or trying to manage and influence actual policy outcomes. It's obviously something typically bipartisan hue and cry about companies and money having an undue influence on politics. And it's because politics has, for most stakeholders, an undue influence on their money and the way they conduct business. And so if we want to discourage the existing sort of best tools that the private sector has to manage that exposure, namely lobbying and influence, buying politicians or financing their campaigns at very least, then why not allow them to simply offset those the adverse impact of the policy changes that they fear, whether it's an increase in the tax rate, whether it's the approval or disapproval of, say, a new vaccine or your competitor's new vaccine, change in regulatory rules for, name your highly regulated industry of choice, financial services, energy, technology, biotech. The list is effectively as long as there are lines of business. So this was sort of our general philosophical approach to trying to bring this asset class into being, trying to arrive at a place where we treat political risk much like any other risk to be traded in risk markets. That the primary difference being that if the underlying commodity, so to speak, that you're trading is an event, the occurrence or non-occurrence of ideally a concretely describable, discrete binary event happening or not. This tax rate is raised or not. This legislation is enacted or is not. This politician is elected over this other politician or is not. So structurally, that's sort of the primary difference when you're talking about event futures. It's not only cash settled, but the commodity, so to speak, underlying it is totally illusory. And in fact, that its illusory nature can make it somewhat difficult to boil down into that discrete and concrete definition I was alluding to. You mentioned also that I worked for a number of years for PredictIt, and this is the unregulated but still legal U.S.-based real money prediction market, similar to what InTrade did a number of years ago, which obviously you're familiar with, Patrick. And for PredictIt, I basically worked in market curation for them. So both identifying what would be interesting markets to trade, to list, but also then how to write the rules for them. And over the 5 years that I wrote those rules on over 5,000 products for PredictIt, we learned a lot through trial and error about just how difficult it can be to specify unambiguously seemingly simple outcomes. Everything from, will the U.S. government shut down due to lack of appropriations, or on what date will a certain cabinet member no longer hold his job, or how many times will Donald Trump tweet this week? Things that seem pretty simple with readily identifiable settlement sources and unambiguous settlement data suddenly would grow from one paragraph to 10 lengthy walls full of text defining all the different edge cases that we would kind of discover along the way. So that's broadly been our overall goal through a number of these kinds of projects, both in regulated and unregulated or less regulated space. Obviously, there's a number of interesting projects going on in the cryptocurrency space too, which operate obviously a little bit of more of a gray legal area, at least in the United States. And you mentioned also that this firm, Sharp Square Capital, that is a fund that we've begun to put together. We've organized the fund, not yet begun raising money for it, but this is tied to yet another similar project called Kalshi, another U.S.-based exchange, which is actually at the other end of the regulatory spectrum as PredictIt, which again is an unregulated market operating under no action relief from the CFTC. Kalshi, on the other hand, is a designated contract market, the same way Intercontinental Exchange or Chicago Mercantile Exchange. So it's they're under that full, regulatory boot of the CFTC. But the benefit of that is that it affords them the ability to cater to a somewhat more institutional clientele. Now, they do have position limits, not as stringent as the PredictIt ones, but that still keeps it from being usable as a true institutional hedging mechanism. But they're large enough position limits that we see an opportunity there for a fund to get involved in terms of providing liquidity and doing some discretionary trading. So it's a number of different pies that we have our thumbs in, but all kind of under the same general philosophy, general thesis that politics can and should be and ought to be and will increasingly be a tradable asset class that not only benefits the direct market participants, but given the nature of these information markets, the price discovery emanating from these prediction markets or information market exchanges, event futures exchanges, are useful to the broader public, both citizens, policymakers, and business owners, homeowners, small business owners, families, trying to better, more accurately handicap the future and make their own, private and financial decisions based on various probabilistic futures that they may be able to better, get a handle on, given that price discovery coming from markets like these. Excellent.
So there we've got the whole scene very quickly, and the whole idea behind the prediction markets, the sports markets, and so on. As you mentioned, yes, I have a little slight pedigree in that myself. In fact, going all the way back to this little tome, Capital Market Revolution, which was my very first attempt at a book in the financial futures format, looking towards the thing that later became known as fintech. I was actually talking about the idea of sports and prediction markets, and obviously, I was a founder, co-founder, and then a director of InTrade, which became also Trade Sports, or GSX Trade Sports, which became InTrade, which then became, I think, Trade Sports again. I honestly got lost somewhere along the line, but certainly I was long gone by the time there was this idea to go into the American market where things were not legal, for the very simple reason that amongst the few things that I will not do in life is wear an orange jumpsuit. And it's quite an interesting environment as to how things have totally changed. Let me just interrupt that right there to say thank you very much, Mike Velasco, for liking us on Facebook. Thoroughly appreciate your support. Thank you also, Marianne Madeira, for the like on Facebook. And if you're watching us this evening, ladies and gentlemen, those little like buttons are really helpful because it races us up to the top of the artificially intelligent, amazing, algorithmic, whizzy things by which search engines decide what other people might see. And therefore, if you want them to learn the sort of things you're learning this evening from watching this show, it would really help us in order to have a little bit of love. Don't forget to ask us a question. I'm here with Pidot. We're talking about prediction markets, and we're at the sharp end of prediction markets in every possible sense. Let us know what your question is. We'll be happy to talk those markets. A couple of things that arose, actually, I was thinking just as you were talking your way through it, Flip. First of all, you mentioned how you're talking about these markets, and now we've actually got the first appearance of a designated content market, which is effectively the equivalent of a futures exchange for the uninitiated, essentially regulated by the CFTC. But it's very interesting because hasn't there also been some movement recently where some other prediction markets more at the sports end of the spectrum have been trying to get regulation, and they seem to have run into problems?
Yeah, that's right. And here you're talking about Eris,
yeah,
right?
Yeah,
and it's interesting. So Eris applied for some sports-related, NFL-related futures contracts to the CFTC, and one of the commissioners, maybe you can correct me if I'm wrong, was possibly Contends, who on his way out, he won't be at the commission very much longer, so maybe felt more free to speak freely. Suggested that contracts on things like NFL outcomes are rightfully under the purview of the CFTC, not just to ban them, but that they should have a home under the existing regulatory landscape, which was an interesting bit of a shift, even if I should say ErisX doesn't wind up with NFL connected futures contracts anytime soon. That was an interesting step forward, at least rhetorical step forward for a sitting commissioner, one among five at the CFTC, where the overarching, the sort of first principle of appropriateness for prospective new contracts on a DCM, as you put it, on a regulated futures exchange in the U.S., is the economic purpose test. So, referred before to risk management or hedging and how we see politics as fitting rightfully within that regime. There needs to be sort of a natural two-sided demand, actual hedging demand, not just speculative demand. Obviously, speculators are allowed to and encouraged to and needed for a properly functioning, liquid, robust futures exchange, any kind of financial exchange. But at the core of it, there needs to be that natural, inherent demand among the market participants. So the thing you're trading, the risk that you're offsetting or standardizing, needs to impact one group negatively and one group positively, so that the market itself can be an efficient way to reallocate or share that risk, with the liquidity then to be enhanced through disinterested speculators. And we've always felt there's a very easy case to make for virtually any policy outcome, political outcome, given that there's usually a winner or a loser when you change the way that the rules are drawn, the rules around commerce. I think it's a credible but much more difficult leap to say the same about sporting events. And you can certainly say, well, okay, the owners of the team, the sponsors of the team, and the star players on the team, and their own brands, these are multi-million, if not multi-billion-dollar concerns, and so obviously they have a financial interest in various outcomes, everything on down to season ticket holders or the venue of a prospective championship game. But it's a much narrower set universe of directly affected natural hedgers. So again, it's not to say that's not a credible argument about the economic purpose of a futures exchange on sporting events or pop culture items, Academy Award winners, things like these. But it's a higher bar to clear, I think. And so it was interesting to see that the CFTC, not that they institutionally were necessarily entertaining it, but again, that one of the commissioners was speaking favorably about the idea. And ultimately, I think it's the way that we'll move as a country and a world, in terms of bring more and more of these kinds of products on exchange. Obviously, things that are more directly tied or historically tied to straight up gambling, traditional gambling, are going to be harder because the regulator doesn't want to become the CFTC doesn't want to become a federal gaming regulator. And so that's part of why sports related futures are going to be among the highest bars. But again, very, very interesting that even rhetorically they're moving in that direction.
It is interesting. And I mean, obviously there was also the history a number of years ago where the Hollywood Stock Exchange was trying to get into being a real money prediction market. And as I recall, they were pushed back very hard because the powers that be in Hollywood itself were extremely unhappy about the idea of speculations over the profits of their movie, although it was never actually entirely clear that they weren't just unhappy at the idea that somebody else might be able to make money out of it, because it would seem that actually movies had an incredible speculative series of people who would like to really truly be risk hedgers in that whole train of movies from start to finish, given the production, the distributors, and all the shareholders who've essentially hedged their risk into it. And it is interesting how that's going. And certainly, I mean, I must say, I think the sports futures market is quite plausible as something, although I understand where you're coming from, that politics are going to be there. I think that leads us into, I mean, we do have a question actually at the moment from Marianne Madeira. Hello, Marianne. It's lovely to hear from you this evening. She was actually asking, do you think there will be an Olympic futures contract? And
so that's interesting. I guess it depends on what it would be tied to. So I believe, and I'm seeing if I can pull it up here in real time, at PredictIt a couple of years ago, we had one on the selection of the host city. Yes, this was on the 2024 Would It Be Los Angeles, and this was whatever year this was relevant, is a couple of years ago, obviously, 4 years ago, I guess. But in terms of contracts on, say, who will win the gold medal in the bobsled, things like that, I think, again, that's sort of closer to the NFL style markets in terms of whether various national regulators would approve them as financial products versus a gaming product or a gambling matter. Again, this is something that I think, I don't know offhand, but I would guess probably does already exist on the crypto-based prediction markets, because they're really much more sort of freewheeling in terms of what can be listed on them. Even within that world, some are more centralized than others. On some of them, even the creation of new markets is totally decentralized. So you can go and put up your own market on whatever you'd like. So I'm sure to some extent those exist within the crypto world. But in terms of actual futures on outcomes of sporting events. I think again I think we'll get there eventually, but I don't think that's kind of right around the corner.
It's interesting though, because the US has been so slow in this whole area, because I don't know whether it's like Calvinist mentality or something that came over from Boston when they spookily landed in Boston in that famous boat all those years ago, having set sail from Boston. But certainly there's a big difference with, say, Europe. And I mean, Betfair has been hugely successful for over 20 years now. And in fact, actually, it's interesting you talk about decentralization of the idea of products, because in fact, originally Betfair was called, originally there was Betfair and there was Flutter. And Flutter, you could actually pick your market, create your market, and effectively it was a decentralized peer-to-peer market, but then it had a centralized platform for the execution, which is sort of almost where we've ended up in crypto terms today with some of the markets you're talking about. And it's certainly very interesting to see how that's turned around the world in terms of, they do have prediction markets on everything, including the Oscars and the Olympics and you name it on Betfair to this day, but it's not necessarily open to US citizens due to regulation or US residents. And it's thriving in Europe, thriving in many parts of Europe. So when you look at, the political landscape to move to there, it's a fascinating, thank you very much, Marianne, for your question, by the way, Marianne Madeira, delighted to see you this evening. When you look at where we're at with the political prediction landscape, well, let me ask, how does that really work in terms of giving me? I can understand how I will put on a hedge very quickly against electoral outcomes, and clearly the elections that have just gone past, there were some quite stark choices in policy terms, or so it seemed originally, on the doorstep. Or in Joe Biden's case, from the basement, when they were out campaigning or not, as the case may have been in the last presidential election. That I can see very clearly. There's obviously, you can make a market and you can decide, who's going to be the next president. And obviously, you can presumably have who's going to be the nominee for the president. And then, of course, that can filter down through hundreds of races. Whatever the third of the Senate that's being re-elected, and the proportion of all of Congress, etc. And I suppose you could have local governors and things like that. How does it work in terms of the prediction markets for something like policy? Things like that.
So it's a little different, primarily driven by the use case and regulatory treatment. For a market like PredictIt, an unregulated market that more caters to retail traders, political enthusiasts, punters, the opposite end of the spectrum from the institutional risk management. On a fully fledged futures exchange, you'd be looking more at what are the binary policy outcomes that are going to have the most significant widespread economic impact. So there you're going to be looking at things like changes in tax rates and tax treatment. If we're live now, we'd be looking at the various infrastructure packages. Anytime that the Congress is slinging around trillions of, $1 trillion buckets of money from one hand to another, that obviously are up to $1 trillion exposures on the line. So, but in the current iteration on a market like PredictIt, it tends to be, again, what's kind of capturing sufficient public attention that a critical mass of traders can form an actionable thesis around it. So if you look at what's going on Capitol Hill, for instance, right now they're arguing over both the infrastructure bill, but also the establishment of a commission to investigate the activities of January 6th, the assault on the U.S. Capitol. And there are several markets on PredictIt that are tracking the actual whip count. How many yeses and nos will there be? Last week it was how many yeses and nos would there be in the House bill. So we were tracking that number very carefully. And this week it's on the votes in the Senate and the procedural vote, and when the procedural vote will happen. And if it happens, will they get to the 60 senators? Will they have a filibuster? If so, will the filibuster be nuked? We're waiting for the moment at which Chuck Schumer may decide we're going to just dispense with the filibuster and go to simple majority rules on these more controversial packages. So that's why I say it depends a bit on the use case, whether it's more for the retail trader or the institutional risk manager. And it depends a bit on the regulatory framework at play also, because PredictIt, while it's a lighter regulatory footprint, given that it's technically unregulated, but still sort of overseen by the CFTC, they do allow actual election outcomes, as well as all of these policy-based questions, Whereas on a regulated exchange, at least from the CFTC's recent and, as far as we can tell, current perspective, election outcomes will be the one category of political outcome that they are not interested in allowing. And it's not necessarily because they don't see that economic purpose, that it can't clear that bar of having sufficient two-sided hedgers. I financially prefer the Democrat. I financially prefer the Republican, depending on what line of business I might be in. But that they feel, or that they have traditionally felt, that simply the existence of the market could give too much of an incentive for someone to try and manipulate the price of one candidate or another to sort of falsely simulate momentum moving in their direction one way or another in order to influence voters at the ballot box on election day. And again, going back to the in-trade example, there famously was the case of the Romney whale back in 2012, who reportedly spent, I think the estimate was between $4 and $7 million plowing money into Romney shares on in-trade to try and suggest to voters. So the same way you might with an in-house poll or a push poll to suggest that momentum's going in the way of your candidate to engender further support or goose donations or whatever it might be, sort of wagging the dog theory of, if you just pretend this person's winning, maybe they will be winning. So I think that was sort of an example of what gives the regulators pause about putting election markets themselves on an actual regulated exchange. And then, of course, it was Nadex, formerly Hedge Street, that called their bluff, turned out to be a bluff, tried to call their bluff on it, and actually applied for approval of electoral outcomes. And Bart Chilton, then commissioner, was on CNBC with, I think, a couple of hours screaming his head off about how they would never allow such a thing. So that didn't do wonders for moving the ball forward in our quest to get policy outcomes on exchange. But outside of the election outcomes, which again are thriving and really the predominant part of PredictIt, at least during the election season, we see no end of policy outcomes that are as interesting, if not more interesting, because if nothing else, they're more readily quantifiable in terms of your EPS impact of a tax change or a regulatory rule being adopted versus which party will be in control in the White House 3 years from now. You can make sort of a directional evaluation of which you prefer, but it's probably harder to precisely quantify what the economic impact is of a given election.
Yeah, it's very interesting. And of course, there's the famous case in the 1960s in the United Kingdom where the horse racing enthusiast, sometime gambler, raconteur, and occasional television chef Clement Freud memorably spent a huge amount of time campaigning for a small by-election seat in Devon, Cornwall, in the southwest of England, and he ended up winning. And he always reckoned that the fact that he'd had considerable gambles on himself in all of these obscure gambling bookmakers' offices through the constituency had rather helped him, because gradually the odds started coming in, and therefore equally he rose in the polls, although it has to be said that was traditionally kind of place that actually voted for his kind of candidate historically as well. So it probably made for a good raconteur story as much as it was anyway statistically significant. He was skewing the vote. So therefore, and by the way, let me say thank you very much. Hello, Trixie Lopez, and good evening also to Nella Mendoza. Thank you very much for the likes on Facebook. We seem to be having a great concentration of excitement on Facebook this evening. If you'd like to get your question in, do let us know, ladies and gentlemen. And I would like to say a word of not very great thanks. If you can hear a live stream ice cream van in the background, that happens to be something that seems to be happening with remarkable regularity at this time during the course of a Tuesday evening. Now, Flip, if you're looking therefore at what you're going to see as contracts coming into the new prediction markets, how are they going to look, and therefore what will it be feasible to hedge as whether you're an industrial participant or whether you're just a private investor?
Well, again, I think it's so dependent on exactly what kind of venue you're looking at. If you're trading on the crypto markets, really can be just about anything. It can be on, will the price of Dogecoin get to $1 by the end of this month? Or will the Tokyo Olympics go forward as planned? We had a question about the Olympic outcomes. That's one that actually Kalshi, this newly approved DCM, is thinking about trading. But I think in the shortest term, at least in terms of sort of the next step, which again seems to be Kalshi, as long as they launch as they expect to, I think early this summer, you're going to see, I think, basically a mixture of geopolitical events, binary geopolitical events, and economic index contracts. So will GDP stay above 5% for the next 2 quarters, or what will the new jobless claims on next report be above or below? Again, these are all still collapsed down to some binary threshold rather than scalar markets, but no particular reason why they couldn't expand into that as well, as long as the CFTC didn't object. But I think with Kalshi, you'll see basically a mixture, at least based on their promotional materials to date. It seems like basically an even mixture between those geopolitical kinds of events, global geopolitical events, rather than being mostly U.S. focused, which PredictIt has been, and the economic indices. But again, longer term, to realize, I think, the potential as sort of fully fledged category of risk management asset class, it basically would mirror whatever is sort of on the presidential and congressional docket or parliamentary agenda, whatever geographic venue you're interested in. And so you'll have some seasonality to it, obviously, around big changes in government or party control, presidential elections, even congressional midterms, things like this, when you have a different party coming into power, when you tend to get kind of more sweeping changes enacted, or at least proposed. And of course, that's the situation we're in the U.S. now, a few months into the Biden administration having the trifecta, bicameral control of Congress, which they're relatively widely expected to lose at least part of in the midterms. Again, if you look on the PredictIt pricing, you can quantify that expectation, that consensus, that they've got really just about a year and a half now left of having control of everything to try and get through as much of their agenda as they can. And so, are you going to see sweeping reforms? Use the word reforms advisedly, but sweeping changes like eliminating the 60-vote filibuster rule, which might then enable them to start adding new states, Puerto Rico, District of Columbia, start adding new justices to the Supreme Court. And if they do that, then what's the knock-on effect of that, of additional Democratic wish list items that could suddenly become in play that wouldn't otherwise be if they needed that 3/5 majority. So it's a long way of saying I don't know. To your question about what's going to be in focus, it can really change dramatically on a dime. Obviously, this time a year ago, or let's say 15 months ago, we wouldn't have known what the following year was going to hold for us as a planet and species. Obviously, from a public health perspective, from a global economic perspective, or from a global geopolitical perspective, and yet it's now the after effects, then not even after, the midstream effects of the pandemic obviously saturate virtually every policy decision made at every level of government. So things could as well look completely different 6, 12, 24 months from now. But the one thing that politics is never in short supply of, it's uncertainty, and the uncertainty on our daily life, yes, but at the end of the day, on your wallet and on your share price and on your EPS, and it's that level of uncertainty that we're hopeful we can use this tried and true, centuries old mechanism of commodity futures markets to help more efficiently reallocate that risk and that uncertainty.
So it's interesting. So you talk about, say, binaries and stuff like that on economic statistics and related things like that, which I think a lot of people can very easily relate to. And they've certainly been tried and tested in various other venues, at least unofficially, over the course of time. I think actually Hedge Street and Nadex were doing some stuff along those sorts of lines even years ago. And certainly, their actual original parent, wasn't it IG, which is in the UK, were doing that and so on. The geopolitical thing sounds very interesting because, of course, we've had a little bit of form there. I mean, wasn't there DARPA and The Economist many years ago? They were going to launch an exchange, which I thought looked really fascinating, but killed off at the time. I think that was what in the George W. Bush era, if I remember correctly, and they were looking at something similar. So, is that going to be the kind of stuff that you're looking for, or you think that you're going to see through Kalshi?
Not that kind of stuff in particular, I don't think, but that is a really interesting chapter in sort of the early history of modern prediction markets. And we had on Old Bull on our podcast a couple months ago, Robin Hanson, who was one of the fathers of that effort with DARPA and what they called the policy analysis market. And it was maligned as terrorism futures, but at the end of the day, that's sort of what the idea was. I mean, they weren't looking to trade on terrorist acts per se, but they wanted to use this market that never really got off the ground because of the public outcry when people learned about it. But they wanted to use the price discovery of these information markets to help our Defense Department get a better sense of emerging geopolitical risks. So it wasn't simply, which city is going to be terrorist bombed next month. And you obviously want to be careful about creating perverse incentives. We talked a bit about the CFTC's nervousness that these markets could impact elections. You obviously don't want to create an incentive whereby someone can go buy a big position on Washington, D.C. being the next victim of a terror bombing and then go and cause the very event in question. But I think at the time it was more, the backlash was more that it seemed icky. It seemed wrong to have a mechanism by which folks who had, by whatever means, a better insight into something potentially bad that was going to happen, have a mechanism by which they could profit off of it. And I think in sort of the court of public opinion, once you get to just that depth of analysis, that's the end of the analysis, and it's not allowed to exist. I think the relevant question, though, is okay. We can have a distaste for that element of it, but does the existence of the market and the information it generates, can it be expected to lessen the incidence of those actual bad underlying things that it's meant to protect against? And it's not to say the answer is either yes or no, but it's hard, I think, again, in the court of public opinion, to get to asking that second level question. Going back to another one that you had mentioned too, with Hollywood Stock Exchange, and this was something we were looking at as a bystander, but still looking at closely at the time, because it was two different firms, Cantor Fitzgerald, which had bought Hollywood Stock Exchange, and then Veriana Networks, now Trend Exchange, which you and I, Patrick, have mutual friends leadership there as well. And they had both gotten approval to trade box office futures, and based on this same kind of idea that it makes perfect sense that producers of multi-$100 tentpole blockbuster movies might want to hedge against having a total bomb at the box office. But the backlash came from the studios and from the MPAA. The subtext to which was basically, we don't want there to be a public price discovery of the likelihood that something we're investing so much money in is going to flop. So the MPAA lobbied Senator Blanche Lincoln to stick into Dodd-Frank an amendment that simply said, for the second time in history, the following products will not be allowed to be regulated by the CFTC, and that was box office futures. So to this date, it's onions and box office futures are the two product categories that can't be traded on exchange in the United States. And the ultimate irony was, of course, then Chris Dodd, after one of the two after whom Dodd-Frank was named, when it left the Senate, he went on to become the chairman of the MPAA, which has now changed its tune and wants these kinds of contracts. They've seen the light in terms of understanding the economic purpose. But it's this same trend, I think, the same pattern of a sense that a certain financial product, in particular a risk product, is objectionable or sort of icky because it makes you wonder about the perverse incentives, or just it seems wrong to profit off of certain things or to have an interest in certain things. But we've seen that everything from life insurance through traditional commodity futures And the argument that, well, can you have life insurance and you have an incentive to profit off of someone's death? Might that even lead to someone causing someone's death in order to reap that financial benefit? And the answer is yes. Of course, every dime store mystery novel is about that very thing. It happens. People kill each other for insurance money sometimes. I don't mean to make light of it. It's obviously terrible, but that fact that terrible thing happens in part because that product exists is not necessarily a fatal indictment of the net usefulness, the net societal benefit of the existence of that product. And so
I think we're at that sort of point where you go back to South Park's fantastic, whatever it was, parental murder porn or whatever their episode was, where everybody's getting killed off. And certainly there is something, right now on a cable TV channel somewhere in the world is a story about a husband and wife where one party killed the other and they just taken out a $150,000 insurance policy. So I get that bit. And equally it's interesting because you look at actually what was the most interesting, one of the most interesting developments out of the South Sea bubble, and thereafter actually they banned the ability to take out life insurance on a third party, which was a very interesting and lively market in the early 18th century. So if you saw me walking down the street and I was coughing and spluttering a bit and you didn't think I was too good, there were a lot of people were buying speculations on those. And actually the way to do it as a leveraged bet was to get in there and buy the first couple of months of premium, and then you would just abandon it if I survived into the third month and recovered from whatever was making me cough. And that was an early regulatory structure. I hadn't realized the Motion Pictures Association of America had actually changed their tune. I'm glad to hear it. In fact, ironically, it would have possibly been the greatest boon in history to the MPAA because it might have helped them garner a lot of money over the course of COVID, because everybody would have been long what box office returns were going to be at certain points in time. And of course, the box office literally didn't open, which is an incredible thing, the force majeure. So that's really very, very, very interesting. Let's just switch gears slightly just a second. We'll come back to this in a moment. Trixie Lopez. Hi, Trixie. Great to see you this evening. She's asking, how can markets limit manipulation? And that's obviously quite an interesting question in relation to whether it's the box office or something else in this sort of fascinating prediction genre.
Right. That's a very good question, and I'm not going to pretend to know the answer, other than to say it's something that we do think quite a bit about. In particular, sort of where do you draw the circle in terms of who's permitted to trade on an exchange like this? So again, for a platform like PredictIt, given that it's unregulated, states quite explicitly, look, don't trade on here if you don't want to be trading in a venue where there might be people who have better information than you, or something that looks and smells quite a bit like insider information. So there's no attempt there, I think it's fair to say, to ward off folks who would be effectively insiders, with the exception of the fact that the Stock Act, the Stop Trading on Congressional Knowledge Act, does in a lot of instances prevent actual members of Congress and their staff from trading on information that they have by virtue of their job that's not public. On a regulated exchange, it's, I think, a little bit more of a delicate balancing act, because of course you want as much good information in the market as possible. Again, you want as good price discovery as possible. You want as fair a price as possible for people entering and exiting positions. So you don't want to sort of wall off so many knowledgeable participants that you're excluding appropriate and good insights from the market. On the other hand, you don't necessarily want, Chief Justice Roberts going and putting a big position down on, how the court's going to rule right before he authors an opinion, either because of the market manipulative effects or simply because it can impact the policymaking. But again, there are a lot of gradations between, John Q. Citizen and the Chief Justice. Obviously members of Congress and their staffs, as I said, are already proscribed by law. But then do you also exclude any lobbyist, or maybe just a lobbyist working on a bill in question within a given market? Do you exclude all the clients of that lobbyist, or a company who knows that they might be about to retain a lobbyist to lobby in favor of or against a certain bill, or shareholders with above X% holdings in a company that may plan to or has at some point in the recent past retained a lobbyist to work on a certain. So you can see you start to draw wider and wider concentric circles, and we haven't really come to a definitive answer in terms of where you try and set those boundaries to, again, incorporate as much good information in the market prices as possible, and yet enable regulators and rank and file market participants to have good confidence that there is a semblance of a level playing field, and that you've, as best you can, I think, tried to approximate the same philosophical guidelines in terms of what is privileged or material non-public information that folks ought not to be using in profiting off of less connected, less insider market participants.
Okay, it's a very, very interesting answer. Thank you very much, Trixie Lopez. Great question altogether. And it's interesting going from one end, which is the ultimate insiders, and obviously one of the most hilarious markets, which even comes up with the health warning, which is in the sports business, not in the political prediction business in the UK, for example, is the next manager of certain sports teams, which have been notoriously prevalent to insider trading and all sorts of weird, wacky, and wonderful odds taking place at different times. Mostly because I suppose if you see a well-known football manager shaking hands with the chairman in the car park or something like that, and you're the gardener, then it's probably a career-enhancing moment if you go off and put your life savings on him being the next manager, on the grounds that he's probably likely to be the man in the hot seat. But that's quite interesting, and obviously you're talking there about the really ultimately insiders and how they can potentially exploit the market, and you need to protect them from manipulation. Thank you very much, Trixie. Now, Mike Velasco is asking a question at the opposite end, because you've been talking a lot about obviously the professional markets and so on, like Kalshi, but you were also talking about PredictIt, which is clearly a much greater melange of everyone from experts through to those who've got only a very, very casual interest in predicting all manner of things. And then how can those sorts of markets truly attract, uninformed or relatively novice traders and start to bring them on?
Well, that's part of the beauty of political trading, is that no trader feels that they are uninformed about politics. It's the one thing that everyone has an opinion on, not only of what who the better candidate is, what the better policy choice is, but what is likely to happen. You find no shortage of overconfidence among traders. And I say that only mildly facetiously, because, in the last few, again, from an American perspective, the last few presidential administrations, the electoral and political theater has become much, much more of a spectator sport. I think to some extent it always has been, but I think certainly the extent to which the average non-political professional is engaged with, at least on an informal level, on a daily basis, political goings on, the actual sausage making, not just the federal election every 2 or 4 years. You certainly do have different levels of sophistication, different levels, but to which the traders are genuinely informed. But again, no shortage of confidence among just about any trader that they are sufficiently informed to come and put some money behind it. But of course, that's what markets do well too, is they quickly separate the smart money from the dumb money, and those that are around for a while to continue investing tend to be the ones that are somewhat more judicious or somewhat better informed, about these underlying events. But it's been interesting too, and I saw this more directly when I was still working for PredictIt, but the degree to which folks who really are not political professionals, maybe enthusiasts or not, they're young professionals, college students, they're sort of interested in politics, and that may have been how they found their way to the site. But within a short period of time are suddenly becoming absolute experts within, either across the political spectrum or within very discernible niches that predictive markets would tend to address. Things like polling markets. A lot of these they don't run series on anymore, but they used to do weekly polling series, both on the generic congressional ballot. Do you prefer Democrats or Republicans? Trump's approval, Trump versus Clinton, Trump versus Biden, head-to-head polling. As I mentioned, on Trump's Twitter market, which is arguably a somewhat more frivolous product category, but obviously Trump went on to prove that it was if not one of the most significant policy setting or policy communication tools of his administration. So I'd argue that it wasn't entirely frivolous, but you had people that were setting up third-party websites to track and analyze and monitor Trump and all the other political figures that we had tweet markets on, to track their Twitter activity and how likely they were to hit certain brackets within these connected markets. People that had never watched a congressional hearing before suddenly pouring through transcripts and reading bill markups and things like that. So the actual civic engagement of folks who, again, maybe were sort of interested in politics but not involved in politics. One side effect of this is you suddenly had many thousands of super well-informed, civic-minded voters and contributors to the political dialogue that you might not otherwise, because when your own money is on the line, that tends to really crystallize your thinking, and it makes you humble. If you come in overconfident, you lose money a couple of times. It quickly humbles you and makes you realize that uncertainty is real, and to the extent that you can actually divorce yourself from your ideological inclinations on the way in, you're much more likely to have some of your money remaining on the way out.
And it's interesting, actually. I mean, you make a great point. Years ago, I remember, because I was being asked about this early concept that I'd had in Capital Market Revolution, this is in the 90s, about the whole concept of sports prediction markets and effectively political prediction markets and so on. And it was at some big futures conference ahead of, I can't remember what it was, the European Football Championship or something. And it was interesting because I said, well, hold on a second, let's go out in the street and ask how many people are interested in what the price of bonds are. And if we're lucky, 2 out of 10 people are going to be interested. If we look further along the tree and ask people what are the prices of interest rates right now, probably you get up to 4, maybe 5 out of 10 people, because they're either savers, they're borrowers, they've got mortgages, and I mean, particularly in Europe where you don't have the American system, so therefore they're actually keenly, acutely aware of what the mortgage rate was. This was, of course, back in the 1990s when we still had a yield curve before quantitative easing killed it. But then I said, who's going to win the next election? Well, suddenly you've got like 8 out of 10 people are going to be voicing a very interested and enthusiastic opinion, even if they don't necessarily know the facts. And then I said, and who's going to win the European Championship football game, whoever it was at the weekend? To which the answer was about 12 out of 10 people had an opinion on it. And everybody had an opinion on it at that point in time. So I think it's a fascinating point that you make, and thank you very, very much, Mike Velasco, for a great question. It's lovely to see you once again. And let me therefore move on to, I think this is a super question, actually, Jay Navarroza. It's lovely to see you this evening. What are some examples of prediction markets' most spectacular forecasting successes and failures?
That's a really, really good question, especially in an era where we've had a series of kind of political black swan events, from the Trump surprise victory in 2016 to the original Brexit vote, and countless more obscure examples that would be only known to the PredictIt denizens that have anguished over them in recent months and years. But the Trump election, his first in 2016, is probably the one that comes to mind most vividly, but I'm not sure which category I'd put it in terms of a success or a failure. So the markets and PredictIt, at least, did not have Trump winning, needless to say, but they were giving Trump a higher likelihood of winning than virtually any of the forecasters, the sabermetricians and probabilistic forecasters, the 538s of the world. That being said, I think 538 gave him the highest odds of any of his ilk. And I think Nate Silver and 538 and PredictIt were roughly on par. Of course, the PredictIt price would fluctuate throughout the day, and of course, on election day, fluctuated quite a lot. On that election day, November 2016, the PredictIt price did get there, show it swinging towards Trump much faster than other real-time indicators. Like, that was the first year I think the New York Times put out their needle that on election night sort of shows the odds wavering between 0 and 100 of who's going to win. And PredictIt was a faster indicator of that. Likewise, PredictIt did not see Brexit coming, but we actually, this is when I was still working for PredictIt, we had some machine learning folks do some kind of under the hood testing of the data, all still fully anonymized, so you couldn't tell who was trading what. But basically, if you were to look backward and say, okay, I want to sort of score internally the different traders according to how well they predict, certain kinds of things, whether it's Twitter activity, elections, vote counts, polling trends, things like that. And then based on their scores over time, when an event is unfolding, if I kind of tweak the score, the overall price, in favor of those that have tended to do better on those markets in the past, do I get a sharper price? And it turns out that yes, not only do you get a better price, but you then can see them coming before any financial markets, global financial markets that were open at the time. In Brexit, you had about, I think it was an hour's head start on the Forex market. So I think you could have captured about a 7 percentage point move in global foreign exchange, which is to say, if you're sufficiently confident in a sufficiently liquid market, that you could have made as much money as you wanted, basically. Yeah. So it's a small universe, right, of data points. So obviously, well cautioned to draw any too broad conclusions from that. But while powerful, markets aren't magical. At the end of the day, they're just an efficient mechanism of aggregating, collective insights. And in a market like PredictIt, which does have this pretty onerous $850 position limit and 5,000 participants per market at a given time, so these artificial constraints do dull that signal, or they limit the degree to which the market is good at separating the wheat from the chaff and distilling the best information, separating that smart money signal from the dumb money signal. So they're not magical. They're just an efficient way to aggregate information and insight and intelligence. So there have been some impressive upsets that the market saw coming before traditional indicators or pollsters or forecasters, financial markets. But for the most part, when they operate best, it's simply the most real time and kind of most granular way to quantify what the crowd, the public at large, the market thinks about an unfolding uncertainty.
Fabulous. Thank you very much for the question, Jay Navarroza. And it's really interesting, isn't it? Because you look at how some of these events have worked out and how they've gone over time. And certainly the Brexit one was quite interesting. I suppose the other hand, we've got to say, were prediction markets materially worse than opinion pollsters over the course of the last 10 years? And I think we can safely say that prediction markets have done better, getting closer to most of the results a lot of the time, certainly in UK elections, for example, and so on. How did things go actually over the Trump election? Because what I'm remembering is we did a panel with you with a couple of guys from the UK, if I remember correctly, right, before last summer. And that was really interesting because at that point in time, all the money was down on Trump. Trump had an incredible runaway amount of money being speculated on him across the prediction markets, as I recall. How did things go there? Was the Biden election victory actually foreseen by the prediction markets, or was it all Trump money?
There was a lot of Trump money in the prices, it would seem, or at least, as with 2016, the market gave Trump a higher chance of being reelected than the forecasters and pollsters. And if you want to go simply by grading the singular probabilistic forecast, that's obviously a worse forecast, right? If you're predicting a binary event and both are saying that candidate A will win, but one is saying A will win with more uncertainty, less confidence that A will win. In this case, the prediction market is saying Biden would win, but less confidently. And he did win, then you have to give the edge to everyone else. But I think the main takeaway from the 2020 election is that it was a lot closer than the consensus believed. And the consensus or average polling delta between Biden and Trump going to the election day, I believe, was 8 or 8.4 points, something like that. And the actual popular vote delta was 4 points less. I believe it was 4.4 versus 8.4 if you went by the polling averages. And so you had a 4-point shift. About half the gap was just polling error. And I think it was another 0.5 percentage point. In other words, if you had a uniform national shift of 4.5 rather than 4.0, that gives Trump the election. So in terms of how off the polls were versus how off they needed to be to have gotten it directionally wrong, they were about 90%, as much wrong as they would have needed to be. So the pollsters and the forecasters defended that as saying, well, sure, the polls were sort of wrong, but we were still right to give Trump up to, in some cases, Biden, I should say, a 99% chance of winning. Many of them had him between 88 to 99% to win going into election day based on that 8.4 percentage point difference in the polling, was to say, see, our polls-based modeling is so robust that even when the polls are completely off and uniformly in the wrong direction, we still got it right. I think the more introspective way to look at that was to say, okay, 2016 showed us that the polls might not only be wrong by a few points, but can be directionally wrong. There was a whole bunch of navel gazing, and they decided, good news, we've fixed all the problems here. We're now waiting by education and other things we didn't used to do. Polls are fixed. You can trust it. They were actually wrong by more in 2020 than they were in 2016, by an extra point or two more wrong in 2020. It's just that directionally they were still right. It was still they picked the right winner. So you get really no reckoning post 2020 in terms of why they've even gotten worse when they supposedly had gone back and fixed the biases, deliberate or otherwise, that existed consistently, always in the same direction within the polling. Not always, but predominantly. So yeah, I think that's the underappreciated lesson of the 2020 election cycle, is that polls have gotten worse and they're less reliable, the more subject to house effect, the more subject to herding. So they tend to be wrong in the same direction. And so you do still have this field, this industry of the forecasters, the black box, model builders, whose models are all built on the polls. I mean, some of them then throw a fundamentals layer on top, a sort of a toggleable enhancement of the polls-based model, but they're all still predominantly polls-based. And so if those forecasters are simply a way of formalizing or quantifying what the polling aggregates tell you, then it's garbage in and garbage out. And I would argue that any mechanism, whether it was a market or a forecaster that looked at the 2020 election on the eve of the election and said there's more uncertainty here than the pollsters are telling you, made a better prediction. Even though they were saying there's a better chance Trump will win than you think, and Trump didn't win. So again, to score it based on any traditional method of scoring forecasters, that's a worse forecast. But I think it was a better read of what the actual situation was on the ground. That Biden had not sewn it up by between 8 and 9 points, and that it was going to be a relatively close election, as measured by how much more of a uniform national polling shift would you have had to see to flip the election Trump's way.
Fascinating altogether. So therefore, let's just ask you one very quick question at the last one. Thank you, Jay Navarroza, for that question. It's been really, really interesting. So Nelly Mendoza is asking, basically, sounds like somebody's very eager to get into Kalshi here. What's the feasibility? When's it happening that we're going to have a futures derivative prediction market in place?
So, and this, I'm presuming the question, on a truly regulated exchange.
Market.
And so Kalshi does have that approval in place. In fact, they just got another piece of it last month or 6 weeks ago, which exempts them from certain Dodd-Frank swaps reporting requirements that were not meant to apply to binary products. So they have the paperwork in hand. I think it's really an internal operational matter at this point, getting from where they are now to having real live trading. Last we'd heard that they'll go to a live beta trading real money products in early June. So that's just a couple weeks from now. And hopefully within a few months, they'll be more fully launched. So this does now seem, knock wood, and you never know until it's actually here, but this does now seem to be around the corner again, not in kind of the fully fledged implementation that we think we eventually arrive at, which is to say this would be viewed much the same way that, again, weather or hard commodities, soft commodities, interest rates are part of the complex of hedgeable external financial risk. But I think within a couple weeks to a couple months, we as an industry will have taken one, very large step there.
Excellent. And therefore, we're looking forward to how Sharp Square Capital Management is going to perform through the course of that wonderfully exciting Kalshi prediction market, which is going to be the first US regulated market, which hopefully answers your show. Nelia Mendoza, thank you very much, Mike Velasco, for your kind comments. Thank you to Marianne Madeira, Trixie Lopez, Jay Navarosa for all of your questions during the course of the show. We've got a week off next week because we're going to be in the immediate aftermath of a UK bank holiday and Memorial Day weekend. Interested to see how the ladies are going to do for Team Pidot Motorsports. They're starting 33rd on the grid for the Indy 500 on Sunday. One looking like a great motor race, even if it's got a socially distanced crowd. We're going to have thoughts from the heart of Wall Street. That's going to be with Kenny Policari, who's a very famous floor trader and media figure. He's coming up on June the 8th, which will be our next issue. It remains for me to say thank you very much to Beata, Racy, and Jamil in production for bringing together this IPO-VID 033. We've been at the sharp end of prediction markets with Flip Pidot, the founder and managing director of Sharp Square Capital Management, and I think it's been an absolutely fascinating discussion. And indeed, I believe there would be 100% predictive power that this has been a most enjoyable and useful conversation. Flip, we wish you all the success. We hope that Kalshi comes to fruition, and indeed that we can see many more regulated and exciting prediction markets in the future. Thanks for joining the show. Ladies and gentlemen, I wish you a great week in life and market, and wish you actually a great fortnight in life and markets. Enjoy the bank holiday next Monday if you're so eligible. We'll see you on June the 8th. Thanks very much for watching. My name is Patrick L. Young. You've been watching IPO-VID Livestream 33 at the sharp end of prediction markets with Flip Pidot.